$100,000. For decades, that number sounded like success. It meant you had made it. A comfortable home, a reliable car, family holidays, savings for the future, and enough left over to enjoy the present. But in 2026, something strange has happened. The salary still looks impressive. The lifestyle it once promised does not. And here is the contradiction. Inflation can slow, your income can rise, and you can finally cross six figures, yet your life may still feel more financially restricted than it did before. So, where does the money go? Today, we are not simply asking whether $100,000 is a good salary. That question is too easy. We are going to follow the same salary through taxes, housing, healthcare, food, transportation, and childcare. Then we will give it to different people, in different cities, at different stages of life. By the end, you will see why $100,000 can feel comfortable, stressful, or completely inadequate without the number changing at all. I hope you are doing well. Welcome to Business Decoded. Today, we are decoding the $100,000 salary trap. The power of $100,000 begins with psychology. It is a round number. It has 6 digits. It separates an ordinary salary from what people have traditionally described as a high income. But the economy does not care about round numbers. It cares about purchasing power, what your money can actually buy after prices, taxes, and unavoidable expenses take their share. The latest available census estimate places median United States household income at $83,730 in 2024. That means a $100,000 household still earns more than the national median. So this is not a documentary arguing that $100,000 is poverty. It is an investigation into something more useful, why an objectively strong income no longer guarantees the lifestyle that many people associate with it. Imagine that this stack represents your entire annual salary. 100 blocks. Each block is worth $1,000. At first, the tower looks substantial. But the figure printed on a job offer is not the amount that arrives in your bank account. For a single taxpayer earning $100,000 in 2026 and taking the standard deduction, an illustrative federal calculation produces about $13,170 of federal income tax. Social Security and Medicare taxes remove another $7,650. Before state income tax, health insurance, retirement contributions, or any other payroll deduction, the original $100,000 has become approximately $79,180. That is about $6,600 per month before state taxes and workplace deductions. The first surprise is simple. The 6-figure lifestyle begins with a 5-figure spendable amount. Now we reach one of the most misunderstood ideas in the economy. When people hear that inflation is falling, many expect life to become cheaper. But falling inflation usually does not mean prices are falling. It means prices are rising more slowly. Think of inflation as the speed of an escalator. If the escalator slows down, you are still moving upward. You simply reach the next floor more slowly. In June 2026, the United States Consumer Price Index was 3.5% higher than it had been 1 year earlier. That rate may change from month to month, but the price level already carries years of accumulated increases. The CPI index stood at roughly 256 in 2019. By June 2026, it was almost 334. That is an increase of about 30%. This does not mean every household expense rose by exactly 30%. Some increased less. Others increased far more. But it explains why an older video about a $100,000 salary can still feel current. The inflation rate changes quickly. The higher price level it leaves behind does not disappear. In the 12 months ending June 2026, food at home rose 2.7%. Food away from home rose 3.4%. Electricity rose 4%. Energy overall rose 15.7%, and shelter, the largest expense for many households, rose 3.3%. Each increase may look manageable on its own, but households do not buy only one category. They pay several of them at the same time. This creates personal inflation. A renter, a homeowner, a commuter, A parent and a person with a medical condition do not experience the same economy because they do not buy the same basket. The official inflation rate is an average. Your life is not. Now let us give our $100,000 salary a person. We will call this person Alex. Alex is not a real individual. Alex is a visual experiment, the same income, moved through different versions of American life. First, Alex is single, has no children, and lives in the Cincinnati metropolitan area. MIT's living wage calculator estimates that a single adult there requires about $44,300 before taxes to cover a defined basket of basic needs. On $100,000, Alex has room above that basic needs threshold. The salary is not a trap here. Managed carefully, it can provide stability, savings, and choice. Now place the same Alex in Los Angeles County. The estimated basic needs threshold rises to roughly $60,200 before taxes. $100,000 can still support a single adult, but housing takes a much larger bite, and the distance between covering the basics and building wealth becomes narrower. Now, move Alex to New York County. The basic needs estimate rises to approximately $79,500 before taxes. The salary did not fall. The location changed its meaning. And notice what these estimates measure: basic needs. They are not a promise of luxury. They do not automatically include the large home, frequent travel, and effortless saving that people often imagine when they hear six figures. The important point is not that one city is good and another is bad. High-cost cities may offer higher salaries, better career networks, public transportation, culture, and opportunity. The point is that income without geography is incomplete information. $100,000 is not one lifestyle. It is thousands of local lifestyles hiding behind one national number. Now give Alex one child. Nothing has happened to the salary, but the budget has changed completely. There is more food, more health care, a larger housing requirement, and in many households, childcare. MIT's estimates make the transformation visible. For one adult with one child, the required income before taxes is about $81,200 in Cincinnati. In Davidson County, which includes Nashville, it is approximately $78,900. In Los Angeles County, it rises above $104,000. In New York County, it exceeds $126,000. The same $100,000 salary moves from being comfortably above basic needs to sitting close to the line, to falling below the estimated requirement. This is why online arguments about whether $100,000 is a lot rarely reach agreement. The people arguing may be describing completely different households. One may be a single renter in a moderate-cost city. Another may be supporting a child in Los Angeles. A third may have two incomes, while a fourth is the only earner. All four can state their experience honestly and still appear to contradict one another. Childcare is especially powerful because it behaves like a second housing payment. The United States Department of Labor's childcare database shows that prices vary substantially by county, the child's age, and the type of care. It is not a small lifestyle upgrade. For working parents, it may be the price of remaining in the workforce. Healthcare creates another gap between salary and security. In 2025, the average annual premium for employer-sponsored family coverage reached almost $27,000. Employers paid most of that amount, but workers still contributed an average of $6,850. That contribution is only the premium. For workers with single coverage and a general annual deductible, the average deductible was another $1,886. Earning more does not make these expenses disappear. It merely changes how much space remains after paying them. The third door is the least visible. It is not where you live. It is when you entered the housing market. Imagine two neighbors with identical salaries and similar homes. One purchased years ago when both the home price and mortgage rate were lower. The other is trying to buy in 2026. In late July 2026, the average United States 30-year fixed mortgage rate was about 6.6%. At that rate, borrowing $320,000 for 30 years produces principal and interest of roughly $2,040 per month. At 3%, the same loan would require approximately $1,000 $350. That is a difference of nearly $700 every month before property tax, insurance, repairs, or homeowners association fees. The two neighbors may earn the same salary, but one entered the market through a cheaper door. This is the housing timing gap. It divides people who secured yesterday's cost structure from people purchasing today's. And because existing homeowners may hesitate to give up an older low-rate mortgage, fewer homes can reach the market. The result can make the path even harder for the next buyer. So when a first-time buyer says $100,000 does not feel powerful, the problem may not be daily coffee or poor discipline. The largest financial gate may have moved. Now combine the three doors: location, family, housing timing. This produces what we might call the personal inflation machine. A national statistic enters at the top, but each household receives a different result. For a single adult renting in a moderate-cost city, $100,000 can still be a very good salary. For a single parent in a high-cost city, it may cover the basics with little margin. For a new home buyer facing current prices and interest rates, the monthly payment may consume the money that was supposed to become savings. For an established homeowner with a lower mortgage payment, the same income may still feel secure. The salary is identical. The fixed costs are not. And fixed costs matter because they arrive before choice. Housing, childcare, insurance, healthcare, and transportation are difficult to reduce quickly. When these expenses absorb more income, households cut the flexible categories first: restaurants, entertainment, travel, clothing, and savings. This matters far beyond personal budgeting. When millions of households make the same adjustment, their decisions reshape entire industries. Restaurants compete harder for fewer visits. Retailers promote smaller indulgences. Buy now, pay later products become more attractive. Employers discover that a salary that once recruited talent no longer travels as far. Cities can lose workers who cannot convert local wages into local housing. And companies selling the American dream discover that their customer can still admire the product while being unable to afford the monthly payment. This is where a household budget becomes a business story. So, is $100,000 still a good salary? Nationally, yes, it remains above the latest official median household income. For many people, especially single adults in households in moderate cost areas, it can support a stable and comfortable life. But it is no longer a universal shortcut to financial security. The number is too small to describe the person's obligations and too broad to describe the place where it must be spent. The phrase six figures survived, its meaning fragmented. The better question is not, is $100,000 rich? Ask, how much remains after unavoidable costs? Can the household save without postponing healthcare? Can it absorb a repair or temporary job loss? Can it purchase a suitable home without becoming house poor? Can the income support the person's family structure in the place where the job exists? Those questions measure financial strength more accurately than the first digit on a salary. The $100,000 trap is not the salary itself. It is the belief that a single number guarantees a particular life. It does not. Inflation changes the price level. Geography changes the budget. Family changes the obligations. Housing timing changes the monthly payment. And taxes convert the headline salary into the money that is actually available. The deepest lesson is simple. A salary measures income. It does not measure freedom. Freedom is the margin that remains after the costs you cannot avoid. That margin, not the round number, is what determines whether a household can save, invest, take risks, and plan for the future. So here is the question for you. In the place where you live, does $100,000 still feel like success, and which expense changed its meaning the most? Share your city and your opinion in the comments. And subscribe to Business Decoded as we continue to explain the forces reshaping